welcome to TheoTrade. This is Don Kaufman, June 16th, 2021, minutes after the cash close here on this Wednesday afternoon over the Fed and through the volatility. Here we go. Let's actually break down a little bit of today's action, but more appropriately, what we can expect for the remainder of this week and get a little bit of a feel for those of you that are selling premium. Again, is it going to be viable in the very near future? First and foremost, the S&P is closed down today. Listen, don't get excited about it. 23 handles. It's only 0.5%. The Nasdaq literally had regained almost everything it lost after the Fed announcement, closing mildly lower, down about 0.39%. The Russell, for the most part, massively unchanged. But as I said, let me actually break down the market because there are some specific areas of interest that kind of surprised me a little bit, that really kind of cropped up after Jerome Powell affectionately started speaking. So let's get to it. Number one over here, what we heard out of the Fed is really not standing in any contrast to what we had heard in the past. They're going to be extraordinarily accommodative, yada, yada, yada. It's transitory, yada, yada, yada. Don't worry about a thing. Again, they're going to be accommodative. That is the easy part. Here's the aspects I don't necessarily think a lot of people caught. Number one on the screen. The marketplace finished, again, only mildly lower, at least in my book. Again, I'm not getting excited about the fact that the S&Ps are off like 0.5%. And I am carrying bearish positions, no question about it. Okay, but one of the key points in here is if you look at the S&P 100, we actually stood very close to heavily correlated to the downside, which it kind of surprised me because the Russell recouped and because of the financials. The financials had a big comeback, all right, after the Fed announcement, and that had to do with the fact that the bond market sold off. We'll cover more of that in just a moment. But again, the key point in here is we have been in a wildly bifurcated marketplace. I mean, Brandon Chapman just did a video earlier in the week about, big, bad, and bifurcated. Well, now we're talking about, again, over the Fed and through the volatility. But one of the key points of this volatility stands in contrast again. And that's one of the things you've got to pick up on as a trader and or an investor is when you start, okay, in a marketplace and you're seeing bifurcation and then a few days later that breaks apart and starts into correlation. This correlation and higher correlation coefficients are much more aligned, if you will, with larger moves in the marketplace. So in effect, what we're saying is if we stay correlated, like in effect we are right now, you're actually going to see the marketplace make a decent sized move that we're not going to actually be range bound like we have been for, a considerable period of time. In fact, let's actually backtrack for just a moment, look at the S&Ps, and we'll look at the S&Ps and we'll actually snap to a 30-day 1 hour. So in the 30-day 1 hour, where are we? Exactly where we were 30 days ago. And it gets even crazier. Wait, there's more. If you come back to the 180-day view to exactly where we're currently at, I mean, this range really started kind of in mid-April. Where are we right now? Well, pretty much a few handles higher than we were in mid-April, exactly where my mouse is on the screen. Nevertheless, okay, let's get beyond the fact that we're correlated. Remember, correlation can be an indication of an alignment with a larger market move forthcoming. Next in the docket, a lot of people miss this. The SPX, the mother of all products. In the SPX, we had an expected move this week, and we have an expected move obviously every single week, but the expected move this week was roughly speaking, and again, I want to get this right on here, it's plus or minus right about $59 and change. So you're looking for this move, $59 higher, $59 lower. Now the $59, again, that was the expected move as of, last Friday afternoon when I recorded the weekend update. So on Friday afternoon of, again, the previous week, we're looking for this $59 expected move. So what happens? The Fed comes out today, right? And you're thinking to yourself, as I said, over the Fed and through the volatility. Question is, are we really through the volatility? And the answer is no, unequivocally, we are not. Why do I say that? Probably the most unusual thing I saw on the screen is at the close today. And this one, I'm still a little bit perplexed. Listen, we just passed through, and why I'm going to make such a big point of this. We just passed through Monday. You just passed through Tuesday. You just passed through Wednesday's trading session. Come on, Wednesday was supposed to be the day. Jerome Powell said so, right? How come we have a $58 expected move? right? You're over halfway through this trading week and you're thinking, that's it, man, I got out unscathed. That actually lends itself to exactly why I called the title Over the Fed and Through the Volatility. You ain't home yet, okay? And you're a long shot from home. You're basically sitting at the exact same expected move that you had on, okay, the previous Friday. How's that possible? They jacked, okay, the implied volatility up. In fact, it's actually worth looking. If you go to the Analyze tab, come over here to Think Back, go to Think Back, we're going to open up the SPX, the mother of all products. Go to the SPX and actually back it up to this past weekend. And if you looked at the June 18th expiration, and again, I'm going to highlight it so you can see it because it's that important, all right? There we are, June 18th expiration. You're looking for like a $59 move on a 12 volatility. Yeah, well, fast forward, what a difference a few days makes, okay? You think that the volatility is over. This says, on the contrary, we're ready to rock. Thursday, Friday, we're actually going to see some decent amounts of volatility. You should prepare for it. Again, you're going to see substantial movement to the amount of the expected move with only 2 days remaining to expiration, which is, again, unto itself extremely unusual. Next in the docket, the bond market. The bond market, strictly from my point of view, the bonds didn't do nearly as much as I would have anticipated. Again, nor did the marketplace. But all it took was just a little bit of sell side activity in these bonds, and it started to, in effect, scare some of the big tech stocks. And that's why we actually saw the Nasdaq, dip and then rip back to the upside. My belief is that the remainder of this week, and again, I want to express, an opinion in this case. My belief is the remainder of this week, the risk lies specifically inside of some of the big tech stocks inside of the Nasdaq. At the exact same time, because the bonds backed off, the interest rates picked back up, and quite considerably so. So the interest rates picked back up. Now, your belief would, again, that would be wonderful for the financials. The moment the interest rates pick their head up off the mat, that's going to help the financials. But ironically, the financials had cracked through. And again, this is important. The financials had actually cracked through, okay, the lower edge of the expected move last week. They closed well outside the expected move. This week and earlier today, they had actually cracked outside the expected move and pulled back in. But, okay, here's again that contrasting view. The marketplace started to correlate. So our belief is that if the Nasdaq starts to fall, it's probably going to pull the financials with it. If you pull the financials with it, you're going to pull energy with it. You're going to get the S&Ps and the entire market move in the same direction in a hurry. What are some of the other major risk factors? Here's where people start to explore the VIX. The VIX it doesn't necessarily do it for me. Again, the VIX it picked its head up off the mat. I mean, this thing was lying dead at the 15 level 3 days ago. It's now at the 18 handle, neither here nor there. Other risk indicators, okay, generally speaking, are flat, except the 9-day volatility. 9-day volatility also picked up, which is once again confirming the fact that we're going to see some decent sized movement in the next 2 days. Last but definitely not least on that particular front, okay, be mindful that the dollar soared. Now, this to me, that is one of the only real definitive and bearish indications on the screen. I believe that everybody runs to the dollar in the midst of what could be some sell side activity. Now, that, okay, expressly is for the next, let's say, day or two, if you're going to sell options premium. I realize that the volatility is picked up. Let it pick up, okay? Sit back if you're going to sell premium, okay, and let the sellers kind of come in here a little bit. I would not, in this particular instance, sell premium at the first sign of some volatility. All right, this is going to be, and it's going to remain a premium seller's market. But with the dramatic move up in the dollar, okay, with the fact that bonds are in a very, very sketchy place right now. If bonds sell off much more than they currently have, you could spark some real panic inside of the Nasdaq. And again, I don't mind selling premium in the face of volatility, okay, but I do mind selling it at the front end of that volatility. If I'm actually going to be involved in selling premium and volatility, I'll tell you right now, I want that to happen, okay, down the road a little bit. I want to be breaking through expected moves. I want it to be ugly. I want it to be big. I want it to be scary, but I'm not going to sell premium at the first sign of volatility. That's it for this evening's video. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.